Amateur landlords are screwing up Canadian real estate, and I'm going to tell you how. You guys asked for a series on this subject, so I'm going to do it. A big factor is that amateur landlords are really bad at evaluating risk and pricing it into their investments, and this commenter works in the insurance industry, so she probably knows a thing or two about evaluating risk. But first, I want to talk about garbage landlord math, because even most of the fundamentals of their investment are not thought out properly. For the most part, whenever I see people talking about investing in a rental property, the only two things they compare are their rent and the mortgage cost. I see this a lot in videos about house hacking. If you haven't heard of house hacking, it's a lot like running a rooming house where you live in part of a house and rent the rest of the house out. The main difference with house hacking is that they call it house hacking. You'll see some really bare bones math in these videos. Rent, mortgage, profit. Rent, mortgage, profit. Rent, mortgage, profit. Or in this case, a small loss. You can own a home, but someone else makes the monthly payments. I almost never see these people accounting for the other costs of owning a property. Costs like property taxes, insurance, maintenance and repairs, utilities, condo fees, HOA fees, etc., etc. By underestimating their expenses, they are overestimating their profits. By overestimating their profits, they're overestimating their return on investment, and by overestimating the ROI, they're willing to bid more on the property and drive up the price. Now, apart from that, what I never ever see in this math is an accounting for risk. And risk in an investment property accounts for things like vacancy rates, or rent controls, or bad tenants, or rising interest rates, which come into play if you're buying the property with debt, which almost all of them are. Now, when you have risk, you should take that into account and reduce the amount that you're willing to pay for an investment. For example, say you were going to buy a house for $400K, but then the person who's selling it to you says that when you buy it, there's a 50-50 chance that the house and the land that's on will explode and you'll be left with nothing. Logically, you'd only be willing to pay about $200K for that house. But if $200K is your whole life savings, you might not even be willing to pay that because you wouldn't want to risk losing your entire life savings on a 50-50 bet. But a lot of these landlords are ignoring the risk and betting even more than their entire net worth on the investment through the use of high ratio mortgages, which I'll talk about in the next video. This is why if you look at multifamily residential units, like an apartment building with 20 units, for example, the price per unit will be a lot lower than buying a condo. And that's because the people who invest in those properties actually understand the rental business and have priced in those risks already. Normally, a single family unit would be a lot more attractive to a homeowner than an investor because you can avoid a lot of those risks. But instead, amateur landlords are ignoring the risks and bidding up properties, saying that they'll make profit on price appreciation. This has led to most of the condos in Ontario becoming owned by investors. And a huge amount of those condos are cash flow negative, meaning that they're bringing in less money every month than they're costing the owner. Which in turn has led to realtors putting out ridiculous articles like this one, winning in the condo market with negative cash flow, which appropriately features a stock photo of someone trying to play chess when they clearly don't understand how. How are you attacking your opponent's king with your king? Why are both the white bishops on white squares? How did this black pawn end up on c8? Who knows? They also confidently state that interest rates aren't slated to rise. It's probably kind of an older article. This is essentially just running an unprofitable business, but imagining that you're going to make profit by selling it to someone else at the end who will pay you more than you paid for it. That's not investing. That's just speculation. Make sure to follow for part 2, where I'll tell you about how the government is encouraging all of this through the rules for high ratio mortgages. Amateur landlords are screwing up the Canadian housing market with their garbage math, and I'll show you an example. This commenter from my last video says that I'm not taking equity into the equation, and it's an investment, not an immediate profit. And please don't pick on that particular commenter because I got a lot of comments to the same effect. I know I've only been doing this for a month. By the way, happy 1 month anniversary, babes. But it still kind of surprises me that people will come into the comments and say really basic stuff like I don't already know. And this is what I mean when I talk about garbage math. Basically every conversation I have with someone who wants an investment property goes the same way. When I point out the mortgage is going to cost them more than they can bring in rent, they talk about building equity. When I point out there's other expenses besides the mortgage, they just talk about price appreciation. But those are just talking points. You still need to actually sit down and do the math. So I'm going to give you an example with a condo for rent and a condo for sale in the same building in downtown Toronto. And I want to be clear, I did not dig for this example. This is literally the first example that I looked at. This is a condo for rent at 357 King Street West. It's a 1-bed, 1-bath. It has in-suite laundry, and it rents for $23.50 a month. It's unfurnished and utilities aren't included, so it'll simplify our calculations. This is a nearly identical condo for sale in the same building for $690,000. It's 1-bed, 1-bath, it's got a washer and dryer, and it looks to be on a similar floor. The only way I could tell it was a different unit was the view out the window and the tiling around the tub. So let's break down the numbers if you bought that as an investment property and rented it out. Let's say you put 20% down and get a mortgage for the rest at 4.89% on a 5-year fixed closed, which was the best posted rate from the big banks today. Your monthly payment will be $31.76, and over the next 60 months, about $64,000 of that will go to principal and $126,000 will go to interest. Your property tax will be around $43.60 a year, and your condo fees will be just under $350 a month. Those of you who know how to add and subtract can probably already see where this is going. But on top of that, you're also going to pay over $20,000 in land transfer tax when you buy the place, so you're starting out $20,000 in the hole. So I plugged all this into a spreadsheet and added a lowball estimate of $100 a month for interior maintenance. On a net cash flow basis, you're going to be paying over $1,600 a month out of pocket just to keep the property running. And if you take out the mortgage principal, the part that actually builds equity, you're still losing $565 a month. That means you're paying $565 out of pocket before a dime even starts going towards equity. Or in other words, you're paying over $1,600 a month to get less than $1,100 a month in equity. Even if you bought it outright and had no mortgage interest to pay, you'd only be making about 2.7% ROI, which is pretty bad. And this is a best case scenario. We haven't even talked about any of the risks like vacancy or a tenant who doesn't pay or damages the unit or interest rates possibly going up in the future. This is why I say you need to actually sit down and do the math instead of just making broad statements about equity. This property does not make sense as an investment at this price. And by the way, I am still planning a video on how the government encourages all this through high ratio mortgage rules, so follow if you want to hear more about that. Canadian housing bubble. Today I want to talk to you about price speculation. In my last video, I gave an example of a Toronto investment condo and showed how it couldn't possibly be profitable at current prices and rent. But I also got a lot of comments asking why I didn't take price appreciation into account in my calculations. And I didn't do that because the entire point I'm trying to make is that the condo is already overvalued at its current price. My contention is that we're already in a speculative bubble and that any further price appreciation would just be based on speculation and not the actual underlying value of the asset. And this is the key difference between speculation and actual value-based investing. With any investment, whether it's real estate or a capital asset like, say, a truck or camera equipment or something that you can use for a business, or even stocks, the underlying value is the benefit that you can get by owning it. With real estate, the main two things you can do are occupy it or rent it out. You can also improve it, but that's basically just to make it more desirable to live in or rent out. So if you're buying it as an investment, you should be able to rent it at a rate that gives you a decent return on investment for the amount of money that you've invested. But as I showed in the last video, even if you're ignoring the mortgage and saying you own the property outright, the return on investment that you get is about 2.7%, and that's being generous. That's assuming no insurance costs, very low maintenance costs, no vacancy, no special assessments by the condo board, no destructive tenants, etc., etc. If everything goes perfectly, you are yielding 2.7% on a risky, completely illiquid, completely undiversified asset. You could get a better return right now by putting your money in a high-interest savings account. Or you could put it into a safe, boring dividend ETF and make even more money that would be taxed at a much lower rate than rental income. So the question I'm asking you is, why would somebody pay you more money for something that's already a bad investment? Imagine applying this type of thinking to any other kind of investment. Let's say you have a friend who opens up a hamburger store, and every month it's losing $1,000. They're not growing sales, they're not improving their product, they're not acquiring more inventory or equipment, they're just consistently losing money every month. And you might say to them, hey, this is kind of a bad business, you're not making any money and you don't seem to have any prospect of ever making any money. And they say to you, no, I'm actually making money because the value of my business is going up by more than $1,000 every month, because businesses always go up in value. That would seem like completely insane delusional reasoning. Generally speaking, nobody's going to pay you a huge amount of money for a business that's not making money and doesn't seem like it's ever going to make money. Although there have been some notable exceptions. And yet, a lot of people have trouble understanding this with real estate because we have a very strong cultural idea that housing always goes up in value, that renting is throwing your money away, and that owning is always better than renting. But if you break down the numbers, you can see that's actually not true. Sometimes renting is cheaper than owning. And house prices can go down. When the last Toronto housing bubble popped in 1989, prices declined for 7 years and took 20 years to recover to their previous high. So the point is, if you can't make money by owning your investment and you're just banking on somebody else to pay you more for your already bad investment, that's not investing, that's just speculating. Garbage landlord math in the Canadian housing bubble. In my last couple videos, I've been going over an example of a Toronto condo and showing how the current price is way too high for it to make any sense as an investment property. Now, anybody who generates an income by investing in real estate will tell you that these numbers do not make sense. But I'm still getting a bunch of comments from people saying that I'm doing the math wrong and that if you take more things into account, then the property somehow becomes a good investment. On the flip side, there were people talking about disadvantages I hadn't taken into account, like tying up the down payment and cash flow in a property instead of another investment. Now, if I wanted to, I could take into account things like rent increases and vacancy rates and changing interest payments over the life of the mortgage and the opportunity cost versus investing in something else. But to do that, I would have to build a much larger and more complicated spreadsheet. So I did! Did you really think I wasn't going to make another spreadsheet? I f***ing love spreadsheets, dog. Here we got the details of the mortgage and property, we got the purchase price, down payment, land transfer, tax, condo fees, maintenance, insurance, it's all in there. I set the mortgage interest at 5.5% because this is an investment property. And then down here we got a bunch of annual escalation rates. I put the condo fees at 3% because this is a new building and you're probably going to see some fee increases or special assessments over time, and I put everything else at 2% to cover long-term inflation. This includes price appreciation, which I put at 2% because the entire point of this exercise is to evaluate whether or not this makes sense as an investment at this price. If you still don't understand why that's important, I have this pen that I will sell you for $100,000. I got this for free at a Super 8 motel when I was traveling for work last year, but since then the price has increased to $100,000. Now you're probably asking, why would I pay $100,000 for a pen? Is it special? Does it do anything that other pens don't? No, it's just a pen, so you can write with it or you can throw it away. The thing that makes this a good investment is the price appreciation. In fact, since I've been talking, the price has already gone up to $115,000, so you want to get in on the ground floor. Moving on, I've got the rent with an annual increase of 4.5%, which is the long-term average, and a vacancy rate of 1.8%, which I just used to derate the monthly rent. For opportunity cost, we've got an investment portfolio where we'll put our down payment and our land transfer taxes, as well as any negative cash flow that we're putting into the rental property. I put the annual growth rate at 7%, but the long-term average is 9%, so I'm being generous to the rental side of the equation here. Then we calculate all of the income and expenses, as well as the breakdown of the mortgage payment on a monthly basis, and extend that out to a 50-year period. Looking at the monthly results, you see you're actually losing money on a net equity basis every month until 7 years into the investment, and you don't generate any cash flow at all until 16 years. Looking at the cumulative results, you don't even break even on the money you've put in on a net equity basis until about 14 years in. Now after that, you'll start gradually turning a profit, and you do actually make a profit going forward, but does that make it a good investment? If you just throw all that money into an index fund instead, you come out about $5 million ahead of what you would have made off the property, and you would have taken on a lot less risk and debt to do so. This also has a bunch of other benefits like liquidity, tax rate, and just being a lot less work than renting a rental property. And keep in mind, this is a conservative estimate of long-term gains. If you use the historical average of 9%, the difference ends up being closer to $18 million. To finish off, we've got a chart of the capitalization rate over time. Most real estate investors say you want a cap rate of about 8 to 10% for an investment to make sense given the capital outlay and the risk involved. And this property crosses into that area at about the 35-year mark, so that's when it would be reasonable to start seeing some price appreciation on an investment value basis instead of price speculation. And now that I've laid all that out, I am done responding to comments about this. I'm not saying that it's impossible to make money on rental properties or that everyone is bad at doing this kind of math. But there's a lot of people who are, and they're driving up prices through speculation rather than through the underlying investment fundamentals. Keep in mind that whoever owns this property has had it for less than a year and they're already trying to sell it, probably because they're losing a lot of money every month. But if you still want to argue that this particular example is a good investment, then make your own video about it and show your work, because a comment is not enough space to address what I've laid out here. And if you still think we should be expecting price appreciation based on these numbers, then I would once again like to offer you this pen for $145,000. But keep in mind that it is springtime, and the market for this pen is going to be heating up. I wasn't going to respond to any more comments on my garbage math videos, but this one just dovetails in so perfectly with some stuff that I want to talk about in my next amateur landlord video that I couldn't resist. Basically, this guy posted to let me know what a genius investor he was for buying a house in 2007 with a 5% down payment. And this goes into something called attribution bias. Now this is a big topic, but part of it is that people tend to believe that their success is due to their own efforts and any failures are due to external factors, but not the other way around. This guy bought in 2007 when interest rates on mortgages were falling to record lows. In fact, since 1990, the Bank of Canada's interest rate has been falling pretty steadily, and up until last year, it was close to zero. And when interest rates go down, house prices go up because you can borrow more money for the same monthly payment. Now, some people complain that my spreadsheet doesn't account for the benefits of leverage because in Canada, you only need a 5% down payment, which means you can be leveraged 20 to 1 when you buy a house. That means if prices go up, you make a lot more money than you put in. First of all, my spreadsheet does take leverage into account. Watch the videos. Go look at the spreadsheet. And second, leverage goes both ways. If prices go down, you stand to lose a lot of money very quickly. And since last year, interest rates have been going up. Also over the past year, prices have gone down by 12.3%. So imagine you buy a house for $500,000 with a 5% down payment. Let's look at a couple of scenarios. And to keep the math simple, I'm going to ignore mortgage repayment and mortgage insurance premiums for high ratio mortgages because it doesn't matter for the point that I'm trying to make. Just try to focus. When you buy the house, you now own an asset worth $500,000. You've paid $25,000 out of pocket and you owe $475,000. Everything's even. Now, imagine prices go up by 10%. You own a house that's worth $550,000, you owe $475,000, and you only paid $25,000. You've tripled your money. Great job. But let's say you bought last year with the same down payment. Now you've paid $25,000, you own a house worth $438,500, and you still owe $475,000. That means you've lost all the money you put in, plus another $36,500. On top of that, mortgage rates have gone up from about 1.5% to 4.5%, So if you've got a variable rate mortgage or you're renewing a fixed rate mortgage, the cost to carry that debt has gone from about $7,000 a year to over $21,000. Now I'm not like a big math guy or nothing, but looking at this, it kind of seems bad. It certainly doesn't seem good. And this is why I keep trying to explain where value in an investment comes from and how it's different from price speculation. Because interest rates were declining for 30 years since the last housing crash, we have almost no cultural memory of anything but debt getting cheaper and housing going up. In fact, I've had people my age look at this and ask me when I think interest rates are going back down to normal. Now that interest rates have hit rock bottom and are going back up, there's no fundamental reason to expect huge price increases going forward. And if you think there is, try making your own video explaining it, because anecdotes about how you bought a house 15 years ago and the price went up aren't really that convincing of an argument.